Look, I just want to, I'm going to introduce Howard, but first, if you don't mind, I'm just curious. How many of you in this room were working before the credit crisis of 2008? Oh, pretty good number.
Majority, I think.
Majority, that's good. Okay, so you have a lot of perspective. Look, it really is my pleasure to introduce you to Howard Marks. Howard is the co-founder and co-chairman of Oaktree, where he spends most of his time determining, communicating regarding the firm's strategic posture. In addition to founding and leading Oaktree, he is extremely well known for his memos to Oaktree clients. He's written these memos for 33 years now. Unbelievable. And his book's The Most Important Thing in 2011, and Mastering the Market Cycle in 2018. And Howard, I want you to know, I have been reading your memos for 20 years, and please keep writing them. I really think they've made me a better investor, so thank you for doing that.
Thank you, Cyrus. You're very kind.
Howard holds a Bachelor of Science Economics degree, cum laude in finance from the Wharton School, and an MBA in accounting and marketing from the Booth School of Business of the University of Chicago. He's a CFA charter holder, member of the investment committee of the Metropolitan Museum of Art, member of the investment committee of the Royal Drawing School in London, emeritus trustee of the University of Pennsylvania, where from 2000 to 2010 he chaired the investment board. And Howard, just because we started this conversation about your memos, I thought I would ask you some questions about a few of your more recent ones. Sure. Illusion of knowledge, what really matters, and sea change. And then after I've asked my questions, we'd be happy to take some questions from the floor. So let's start with the illusion of knowledge. For this memo, you discussed macro forecasting, and for many years you've expressed why you're not so interested in macro forecasts. So why is it so challenging for somebody to create a helpful macro forecast?
First of all, when you say for many years, the first memo was written in 1990. It was entitled The Route to Performance. The third memo was, I think, in 92, as I recall, and the title was The Value of Predictions. So it's a recurring theme, nothing new. The title of the memo, The Illusion of Knowledge, comes from the historian Daniel Boorstin, who said that the enemy of knowledge is not ignorance, it's the illusion of knowledge. It's the belief that people know that keeps them from exploration, which ends in knowledge. And maybe it's, I guess Mark Twain said it the same way, but a little more colloquially. He said, it ain't what you don't know that gets you into trouble, it's what you know for certain that just ain't true. You know, look, I say in the memo that when I was a kid starting out at Citibank in the 70s, we used to talk about a lot about econometrics, which is something you don't hear much about anymore. But econometrics is the construction of a computer model which simulates the economy. All you have to do is provide the appropriate inputs, turn the crank, and you get a macro forecast. But how the hell could anybody build a model of an economy? There are billions of people in the world creating the economy. Thousands, maybe millions of business entities, government entities. And how can you model their behavior without extremely simplifying assumptions which cripple the process? How can you model not only the rational decisions they're going to make about money, but how about their emotions and their swings of psychology? And what do you do about randomness and luck and chance and exogenous influences and weather and all these things? And so, you know, when I was in school, we used to talk about GIGO, garbage in, garbage out. You make simplifying assumptions that are flawed, you can't possibly have valid output. So that's number one. Number two, people have biases. And our expectations, our pronouncements about the future are usually very, very much clouded by our biases. The greatest one of which is confirmation bias. We hold a view about what the future holds. We read something that agrees. We say, aha, I'm right. We read something that disagrees. We throw it out, disregard it. And I mentioned in the memo that I read a book last summer called "Mistakes Were Made But Not by Me," and it's a very good book, Carol Tavris, and it's on the subject of self-delusion. And people receive information, and that's how they dispose of it. And we have this thing called cognitive dissonance, which permits us to live with or deal with views that go against our own. And I think that some of the greatest practitioners of cognitive dissonance are the forecasters. And I say, you know, again, early in my career, I heard the saying that an economist is like a portfolio manager who never marks to market. And you know, when I go in to get business, Cyrus was talking about the great performance at Brookfield in private equity, 27% gross return over the whole life. Can you imagine if an economist went in for business and didn't give a track record? How do you get hired? Well, they still do, the answer is. You couldn't get hired without your track record. Economists can. So for many, many, many reasons, and one of the things I say in there is that you look at the Fed. The Fed, I think, has between 200 and 400 PhD economists on the payroll. Not only can they not predict the economy, and by the way, they kind of lost it on transitory, but they can't even predict their own actions. If you read about what the Fed's going to do next year, they're usually wrong. So, you know, perhaps John Kenneth Galbraith said it best. He said we have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know.
Not how you would have done.
So Howard, we've got a lot of investors here, some relying on economic forecasts, I assume some not, but how should they go about their decision making?
One of the most insightful questions that I get, and I've gotten it a few times since writing that memo, is you make investment decisions with regard to companies and properties based on forecasts of earnings primarily. You know, there's a lot else, but it's subsumed under earnings, cash flow, and so forth. Don't you need a macro forecast to be able to predict earnings for a company? And I say, aha, that's it. You got me. Because you do. We have to make forecasts of earnings for companies, but we can't rely on macro forecasts. It's a great challenge. The answer is, in my opinion, that we make what I call neutral forecasts with regard to the macro, which is essentially we predict that the macro will be like it always has been on average. I know that's probably wrong, but I don't think I can improve upon it. If I predict, you know, the U.S. economy's grown at a little under 2% a year for a long time now. I can predict 3 or I can predict 1. I'm probably wrong. It's probably going to be 2. Now, if I predict 3 and I'm right, I'm going to make more money than other people. If I predict 1 and I'm right, I'm going to make more money than other people. But most of the time it's going to be 2, and the predictions of 1 and 3 are going to be fruitless. So we make a neutral assumption. This is especially important, I think, if you look at a company or a property or an asset where the decision to buy it would have to be predicated on a non-neutral forecast, well, now you've bet your outcome on whether that non-neutral forecast is right. And we don't want to do that. We don't bet on forecasts. One of the, Oaktree runs according to an investment philosophy which has 6 tenets, one of which is that our decisions are not predicated on macro forecasts. I guess one way to sum it up is, where are all the rich macro forecasters? We have people who are famous for doing very good investing, from Peter Lynch to Warren Buffett, and not only did they not get famous from macro forecasts, but they mostly rail against macro forecasts. And we don't have that many people who got famous or rich from macro forecasting.
Howard, let's move on to the next memo, what really matters. And there are 2 themes here that I think it would be really insightful for people to hear from you on. One, you talked about several things that shouldn't matter for investors, in particular short-term events.
Right.
I'd like you to touch on that. And then you also talked about the perils of short-term trading compared to owning I think what you said is owning a stake in a business, effectively. But could you touch on those concepts, please?
First of all, before I do, let me just mention that Cyrus has referred to these memos. Anybody can get them. They're all on the internet at oaktreecapital.com under the heading of Insights, going back to the beginning. And the price is right, they're free. So I hope you'll look. In particular, I hope you'll look at what really matters, because I think it was one of the better ones and one of the more important ones, and it's one that I got almost no reaction to, which happens a long time. By the way, from 1990 to 2000, for those 10 years, I never had one response. Not only did nobody ever say, that was great, which is what we live for, nobody ever said, I got it. And so one of the great mysteries is how I kept doing it. But anyway, we had a conference in London on June 21st of last year for our European and Middle Eastern clients. And I kicked it off with the discussion of the environment and then took questions. And then after lunch, I got back up and I said, and unscheduled, and I said, you know what, I'm disappointed in the conversation of this morning. Because the only questions I got were, what will inflation be? How high will the Fed raise rates to reduce inflation? Will it produce a recession? When? How bad and how long? So inflation, rates, recession. These are not the things that matter. First of all, we can't know much about these things. Secondly, if we were going to do anything if we form views, we probably wouldn't do much about it. Because I've seen a lot of people discuss, I've been on a lot of investment committees, as you described, Cyrus, and they spend a lot of time discussing the macro forecast, but they don't make big changes in response to their conclusions, probably because they don't really believe what they just agreed on. But, these are not the things that matter. And what I said was, what we try to do is we try to invest in companies that will become more valuable over time, and debt instruments where the issuer will pay the interest and principal as scheduled. These are the things that matter.
Fundamentals.
Fundamentals. And, I describe in there around 2016, or late 15, 16, when the Fed started talking about raising rates. I believe that they kept rates way too low, way too long. And then they got into this bind where if they started talking about raising them, they had a revolution on their hands. But anyway, I went through a long period of time, and the only question I got was, when will the Fed start raising rates? And I think I say in the memo, what does it matter? If I say March, what will you do? If I say, no, not March, May, what will you do different? You know? And it goes back to the illusion of knowledge. And by the way, one of the quotes in that memo, somebody said, you know, if people understood how uncertain the world is, they wouldn't be able to get out of bed in the morning. And so they cloaked themselves in forecasts to make the environment tolerable. And so, in early 2016, when will the Fed start raising rates seemed like an obvious question that one would like to have an answer to. But it doesn't deal with the question of, is it possible to obtain an answer to that question? And what would you do if you had the answer? Warren Buffett once said to me, as he said many times, that for a piece of information to be desirable, it has to satisfy two criteria. It has to be important, and the macro is extremely important. In fact, in the last 20, 25 years, it feels to me like it's the only thing people care about anymore. But it also has to be knowable. And I believe that the macro is not knowable in the sense that to be superior investors, all of us have to have an advantage, what I call a knowledge advantage. We have to know something better than somebody else, or clearly our investment performance will be average. But I don't think it's possible to know more than others about the macro. And consequently, I don't think that trading, which is in response to expectations regarding short-term events, I don't think it can be successful. And so I start the memo by talking about 5 things that I think don't matter. Short-term events, short-term trading, short-term performance, hyperactivity, and volatility. And, you know, volatility, I mean, first of all, most people have subscribed to the view that volatility is risk. I don't think so. I think that the important risk is, the 2 most important risks are, number 1, the risk of permanent impairment of capital, or the risk of not taking enough risk and underperforming. But, you know, we care so much about volatility, and of course, a lot of performance is evaluated based on the Sharpe ratio, which is essentially the relationship between return and volatility. But why? And Buffett says, I'd rather have a lumpy 15 than a smooth 12. And I say in the memo, if you'd rather have a smooth 12 than a lumpy 15, you got to think about why. Is it for financial reasons, or is it for psychological reasons, emotional reasons? But I think that these are the things that should matter, but I think that these are the things that investment committees in particular spend the vast majority of their time discussing.
And Howard, why do you think, you know, it seems to me there's enormous focus on the short term.
Yeah.
Especially for, I'm going to say, public stock investors,
Yeah.
Anybody buying a security. Why is that? Look, most of what we do at Brookfield is private equity of some sort or another, and we own things for a long time.
Yeah.
So I don't understand the short-term thinking. What's driving that?
The great question spanning those 2 memos is what you just asked. Why so much time on what doesn't matter? And why? You know, look, why do you spend your time trying to develop a macro framework? And maybe if more people spent their time thinking about whether a macro framework can be helpful, they would change their behavior. But I think, and I talk about this in the memo about knowledge. But I think that most people think you have to. Most people think it's their job. Most people think it would be unprofessional or irresponsible to not hypothesize about the rate of growth in the economy and the level of inflation and the outlook for rates and currencies and commodity prices and that kind of thing. And they consider these things important, but they don't grapple with the question of whether they're knowable. And so, at Oaktree, what I say is we ignore the micro, which is unknowable, and we focus on the macro. We focus on the micro, which is the knowable: companies, industries, and securities. And if this is a value conference, which is predicated on, I think, studying the micro. And if you read most value books or speak to Buffett and people like that, there's not a word about the macro. If you work really hard studying companies and industries and securities, I think you can get an edge that you can't get in trying to forecast economies and things like inflation and rates.
That sounds like great advice for our younger investors.
Yeah.
All investors. Okay, let's move on to your I think your second last memo, Sea Change,
Yeah.
which you wrote in December. And look, just to give all of you some context, Howard has had an incredibly successful investment career for 53 years. Not many of us can say that. And you say, the reason I point that out is you say we've only had 2 sea changes, and we might be in a third one.
Yeah.
So this is really meaningful. Before we get into specifics, what is a sea change in your mind versus just a normal up and down cycle?
A sea change, well, this is a really important distinction. A sea change is a fundamental change, for example, in the environment, where everything is different. The way things work is different, the underlying processes are different, the causal environment is different, and the attitudes are different. And, it's really important to distinguish it from a cyclical fluctuation. Those things come and go. But if you're in a different environment and you could figure it out and act accordingly, I think it could make a big difference. So I talk about 2 sea changes that I've lived through. When I started work at Citibank in the late 60s, the bank was a devotee of what was called the Nifty 50. Growth investing really was invented and named, I think, in the early 60s. And the world fell in love with the so-called Nifty 50. Supposedly the 50 best and fastest growing companies in America, where A, nothing wrong could ever happen, and B, as a consequence, there was no price too high. And they said, well, if the PE ratio seems a little high, just wait a couple of years and the companies will grow into its PE ratio. So it really doesn't matter. And the real mistake was not owning them. And there was great unanimity about these companies, which of course is extremely dangerous. And so if you bought the stocks the day I got there in September of 1969 at Citibank, and if you held them for 5 years firmly, you lost over 90% of your money.
90%.
In the best companies in America. For the simple reason that, number one, half of them ran into trouble, and number two, the price was just too damn high. And these are stocks that, for the most part, were selling between 60 and 90 times earnings. IBM, Xerox, Kodak, Polaroid, Merck, Lilly, Avon, Texas Instruments, Hewlett-Packard, and Coca-Cola, and so forth. And so that was a that was a climate in which the job of the investment professional was viewed as buying good things. And by the way, under the old fiduciary law, if you bought 10 things that were not commonly agreed to be good, and 9 of them made money and 1 lost a little money, you could be surcharged for having bought that one. If the job of the fiduciary was to buy investment grade bonds, you just couldn't buy non-investment grade bonds. That all changed in the important sea change of 1977-78, when people, you couldn't issue a bond without an investment grade rating before that time. And Mike Milken and others, their great contribution was to assert that you should be able to issue non-investment grade bonds, and you should be able to buy them as a fiduciary intelligently if the promised return is more than ample to offset the risk. And I think it's clear that this has become the way we think today. Nobody says, these are good, these are bad. By the way, Moody's in 1978 defined a B-rated bond as follows: fails to possess the characteristics of a desirable investment. Bad. Good. Nifty 50 good, B-rated bonds bad. So I reached the conclusion that it's not what you buy, it's what you pay. And I think the world reached that conclusion. And today we think about what's the return, what's the risk, is the return more than compensatory for the risk. That was a big sea change. The second sea change came shortly thereafter, because in the 70s we had a bout of inflation in the United States in the mid-teens. Nobody could figure out how to stop it, and it was really a dreary, depressing period, led by 2 guys called Dr. Gloom and Dr. Doom. Al Wojtenlauer, chief investment officer, chief economist of First Boston, and Henry Kaufman, chief economist of Salomon Brothers. And finally, they appointed Paul Volcker as chairman of the Fed. He took interest rates, the Fed funds rate, to 20. That killed off the inflation, killed off the economy, but it did solve the immediate problem. And I got a slip from a bank. I had a loan outstanding at the time, and I got a slip saying the rate on your loan is now 22 1/4. December of 1980. 40 years later, I was able to borrow money at 2 1/4. And the decline of interest rates by 2,000 basis points over those 40 years, in my opinion, was the most important single event in finance over that period. But if you ask most people, what was it? They might say the Big Bang, they might say, the Black Monday, they might say the global financial crisis, lots of things. I think it was the decline of interest rates. And we were talking before about private equity. I think that most of the money that was made over that period was made because interest rates came down. Most people don't recognize that, but I think that was very important. And after the global financial crisis, of course, the Fed took the Fed funds rate to 0 at the beginning of 2009, kept it there 7 years, which seems to me they overstayed, engaged in QE, flooded the economy with liquidity. It produced the longest economic recovery in history, the longest bull market in history. It made it very easy to raise money, very hard to default or go bankrupt. Life was easy. As a consequence, the holders of assets were happy, the buyers were eager, the prevailing fear was FOMO, the fear of missing out. Nobody was really afraid of losing money, because they couldn't think of a way they could. And of course, interest rates were extremely low. Yield spreads were tight. The prospective return on credit, which is most of what Oaktree does, were the lowest I've ever seen. And if you go back to the beginning of 22, high yield bonds yielded in the 4s. Many of them were in the 3s. There was one issue in the 2s. So we couldn't call them high yield anymore. But think about this environment. This was a great environment for asset owners because the value of an asset we value, people think, is the discounted present value of the future cash flows. If you discount at a lower rate, you get a higher present value. That's easy. So it was great for assets. Also, of course, if you own a piece of a business in the longest economic recovery in history, you probably would have had to struggle to lose money. So that was another reason why it was great to own assets. And then the other thing is, of course, the cost of capital declined, which was very, very salutary for businesses, but also for people who borrowed in the normal course of life. So, now what if you owned assets with borrowed money? That was a double bonus, because your asset become worth more, your cost of capital went down. And so I don't want to say that the business of private equity was easy in this period, but maybe it was.
Should I be retiring now?
I think it's a chance to quit on top. And I compared in the memo. I wrote it when I was traveling in Asia in the fall. So I compared it with going to an airport and being on a moving walkway. And if you stand on the moving walkway, you make reasonable progress. But if you walk on the moving walkway, then your progress is the sum of your speed of walking and the speed at which the walkway moves relative to the ground. So you move fast. Now, you might think you suddenly became a fast walker. So you should understand what's going on in your environment. And I believe that in this period, people didn't understand it. And I compared the 40-year decline of interest rates, kind of the frog in the water, You put a frog in a pot of boiling water, he jumps out. But if you put him in a pot of cool water and you put on the gas, the water heats up and he sits there and dies because he doesn't realize what's happening. And I think that so many people made so much money in that period because of the ease of the environment without recognizing it. It was a massive tailwind. Very good for asset owners and borrowers, very bad for lenders and bargain hunters. And of course, value investing suffered in this period. Our returns in distressed debt are not as good as yours. We only average 22% a year gross and 16 net. But we don't use any leverage. So if you can get those kinds of returns, and by the way, and the funds we formed that invested during crises did much better than that. It gives you an idea about the bargains we were able to buy over that period. Because, by the way, we're all value investors. Our job is to buy things for less than they're worth, right? Yes. Okay. What's the hitch? It requires the cooperation of somebody who's willing to sell it for less than it's worth. When do you get that cooperation? Usually in times of panic. We do. So in this happy period from 09 through 21, nobody was eager to get out of anything. There was no urgency. Nobody said, "I'll get me out at any price." Nobody had people didn't have withdrawals from funds. There was no knife hanging over people's heads. So it was a very, very difficult period for bargain hunters. And from 2012 to 2020, I gave a speech entitled Investing in a Low Return World. But guess what? We're not there anymore. Because now, because of inflation, the Fed, rather than lower rates, has raised rates, has curtailed and to some degree reversed quantitative easing. Now people are really afraid of the recession that may lie ahead. So the buyers are not so eager and the holders are not so complacent. But now we as credit investors have adequate base rates, decent yield spreads, and attractive total prospective returns. So this is a major sea change. I'm not saying that rates have come down and are going to go back up. I'm going to say they've come down and are basically going to stay here for a good period of time. And I've already spent a lot of time talking about how much I dislike macro forecasts, but I say in the memo that I think that the Fed funds rate for the coming years is more likely to be averaged between 2 and 4 than 0 and 2. And it was between 0 and 2 for a really long time, and that created the environment I'm describing. And so if instead it's between 2 and 4, I think that's a big sea change, and I think that a less easy period in the next 5 to 10 years will change what works and what doesn't.
Howard, my perspective, from my perspective, we were in a period of time where there was virtually no differentiation between a great company and a lousy company in the credit markets.
Right.
Very little. And before the credit crisis, before the GFC, we did quite a bit of, I'm going to call distress for control type of investing, and there has been virtually none of it.
Right.
None. Now, it's coming back,
Yeah.
I think.
Yeah.
Is it possible?
I think
See
it is.
more of that?
Yes, I think. Well, look, in my first 30 years in high yield bonds, from 78 to 08, the average default rate in the universe was 4% a year. From 2010 to 2019, the average was 2%. And there was only one year in which the default rate got up to the average. There were no years in which it was above average. So, yeah, I mean, look, Cyrus, if you, the period I described was growing economy, declining cost of capital, and ease of financing. If you could wreck a company in that environment, you deserved to go into default or bankruptcy. But it was tough because people would just throw money at you to rescue. So I think that, you know, you started off by saying who here was investing, what, before the GFC, was it?
Yeah.
You had to be investing before the GFC to have seen different times, by definition. You know, I always imagine that the people who came into the business in the last 14 years are saying, well, when are we going back to normal? Like 2015 or 2016 or 2017? That was not normal. That was good times. Now, what I thought you were going to say is who in the room was was investing before interest rate hit 20 in 1980, and not so many. And by the way, our environment, our business was so horrible in the 70s that you literally couldn't get a job, which means that if you were working in the 70s, you probably got your job in the 60s, and there aren't that many of us left. But you had to, and so I think that the last 40 years were not normal times. They were a period in which interest rates were consistently either declining or low or both. And that's not normal because rates are usually cycle related. So, and by the way, the 70s weren't normal because they were dominated by the inflation. So I think the 60s were normal, but most people don't have a direct recollection.
What was the 10-year treasury in the 60s? Do you remember?
Oh, I think it was about 5.
Okay.
Yeah.
Kind of feels normal.
Feels normal. By the way, in 05, 6, 7, I was very worried about the markets, so I had all my money that wasn't at Oaktree in 1, 2, 3, 4, 5, 6 year treasuries, laddered portfolio, dumbest form of investing known to man. And I was getting close to 6.
That's great.
And today those things pay, 2 to 3, and a year ago they paid a fraction.
Okay, I have a couple of more questions, then we're going to open up to the floor. I think I've got my timing right here.
You want shorter answers?
But no, we're doing great. You're doing great. And this is a little unfair because I didn't have a chance to talk to you about this, but AI, artificial intelligence, how is this, in your view, going to impact the investing industry?
I wrote a memo 6-ish, 7 years ago called Investing Without People. And I reviewed indexation and passive investing, algorithmic and systematic investment, and then AI and machine learning. I have to start stories at the beginning. So for me, this starts when I was in grad school at the University of Chicago, as you described, and the professor made mention of the fact that the average, the vast majority of equity mutual funds did not perform as well as the S&P before fees, and of course even more after fees. And he said, well, why don't they just buy one share of every stock in the S&P? We didn't have the concept of an index fund at the time. Jack Bogle really created that in '74. But, you know, we lived in a dumb world. There wasn't much information. There wasn't much information transfer in the 60s. And so you could do that. You could charge high management fees for running an equity mutual fund and underperforming the S&P. Oh, clearly that has changed. The majority of equity mutual fund capital is now run index or passive, and at a fee of a few basis points. So, you know, this was a weeding out, and one of the things that's supposed to happen in a capitalist system is a weeding out. We talked about the fact that one of these days there may be fewer private equity funds, because the world really needs thousands of them. But, you know, we stopped having a condition where you could give inferior performance and charge a high fee. Rightly so. And I hasten to point out that, and now the majority of capital is run passive or index, not because it's so good, but because active was so bad. And you shouldn't be able to charge highly for it. Now, let's go ahead to AI, which is in the news big time today. What I was told in college was that what a computer can do is add, subtract, compare, remember. Those are the essential things they do. And that's not a great list. Oh, but they can do them without computational errors. They can handle a lot of data very fast, and they can do it without emotional errors. So now it starts to sound better. And in fact, maybe that's better than most people. So this is why these processes have turned over to automation. And, you know, the people who were charging high management fees and giving inferior performance shouldn't be in the business, or shouldn't be able to get those fees. And now I imagine fewer are. And we're all of us active investors are now held to a higher standard. And that's not going to decline. But the question is, will AI and so forth doom all of us? And I like to believe that the answer is no, because I like to believe that there are some things that we can do, that the best investors can do, that others can't do. The examples I give are, can a computer sit down with 5 business plans and figure out which one of them is going to be Amazon? Can a computer sit down with 5 CEOs and figure out which one of them is going to be Steve Jobs? And in our own world, can a computer sit down with the records of a bankruptcy proceeding and figure out how the company's going to be restructured? And I think not. So I think that AI and so forth will not be able to deal with qualitative and future-oriented. By definition, AI and machine learning know everything about the past, and they can figure out what has worked in the past. But I don't think they know everything about the future. And some small number of investors, I think, will be able to do that in a more satisfactory way.
Okay, so the good news is maybe I don't need to retire.
I think that's right.
We're gonna move on now and take some questions from the floor.
George?
Yeah.
So, interest went down from 1980 to now, 2 years. This led to a vision of values. Why it went down? Because inflation went down.
Yeah.
Do you have a view or an idea why inflation went down? And has the environment changed going forward that may cause a reversal?
Okay, so rates went down over that period, largely because inflation was declined and was quiescent for a long time. And is the outlook for that changing? Yes, clearly the 20% interest rates was just like a dose of medicine designed to solve the problem, and it did. the inflation's kind of mysterious. I would not say we know how it starts. We don't know. For a long time, we didn't know how it stops. We found this thing called the Phillips curve, which relates inflation to the level of unemployment. But then, in the last decade, we had declining unemployment and no inflation. So it's not predictable. The inflation in the 70s was really kicked off by the OPEC oil embargo, which got people thinking about price increases, and it caused inflationary expectations to be embodied in psychology, and once it gets in there, it's hard to get out. So inflationary expectations are self-fulfilling, because if you believe that the price of something will be higher a year from now than it is today, then you'll buy it today, which will put the price up today, or you'll invest, or something like that. So it is self-fulfilling, and then Volcker broke the back of it, and we didn't see it for there was one bout in the teens, but other than that, we didn't see it for 40 years. I think that the world economies are actually growing slower now, which should be less inflationary than in the past. On the other hand, we are missing the salutary impact of forces such as globalization. And, in one of my memos, I showed a table where I showed that the prices of consumer durables had declined by 25% in real terms. 40% over a 25-year period. As I recall, the period was 1990 to 05 to 15, which of course coincides with the offshoring of jobs and the sourcing from first China, first Japan actually, of course, then China, and then and now other countries like Bangladesh and so forth. I think that if you weighted the decline of 40% in the prices of durables, took about 0.75% off the rate of inflation. So if we don't have the same benefits from globalization, then you just add on that. Other things, there'll be pluses and minuses. We're now onshoring, and clearly it costs more to produce most things in this country, certainly technical things, small work, than it did. So that all else being equal, if you want to make a neutral forecast, you take the prevailing rate of interest and you add 0.75, and I'm sure that's wrong. You just would have to be an optimist to expect inflation to be as quiescent as it has been.
Next question.
Hey, Howard. Quick question. How would you advise your son, who's a VC, to invest in this new sea change?
I think it's not relevant to him. By the way, I would suggest that he invest carefully. Look, he came out of, the period I'm talking about is 09 through 21. Guess when he came out of college? 09. This was a great period for expansiveness, imagination, creativity, entrepreneurship, startups, availability of capital, etc. Again, it wasn't a normal period. You have to understand the environment you're in and have been in. And so, you have to be very careful. But the other thing is I would recommend that he be lucky. And he had a small fund, just his money and his partners. Then he brought in friends and family, did very well with that. And then, guess what? Last February, he raised a large amount of money and he didn't spend it. So he was lucky, which I always recommend. Good luck. But you can't, look, 97, 98, 99, 2000, venture capital was going crazy and making money like crazy, and the people who invested were making money. I think, as I recall, that Duke in fiscal 2000 made 350%. in its venture portfolio, and as a consequence, its whole endowment was up 28%, which is exactly the moment when I took over chairing the investment committee at Penn, July the 1st of 2000. Penn was led by a guy named John Neff, who was literally the Warren Buffett of the 70s. And Warren Buffett was not the Warren Buffett of the 70s. But Neff was a deep value guy. So all Penn had was deep value stocks. We had deep value large stocks, deep value small stocks, deep value foreign stocks. But we didn't have any tech, any growth, any venture, any buyouts. And so in fiscal 2000, Duke made 28%. Penn, I think, probably lost 2 or something like that. So, you know, that it was a boom, great boom. But what happened? The typical venture fund had been, let's say, 100 million. I don't know if that was the right figure, but I think that was close. And then in 01, of course, they could raise 2 billion. And nothing kills returns more than too much money. And fast forward 5, 6, 7, 8 years, people were calling me saying, do you think venture capital is still an asset class? Do you think we'll ever see another new venture fund? Because they did so badly. But one thing we have to, you know, Cyrus mentioned that my 2018 book was called the Mastering the Market Cycle. And the last chapter is entitled the Cycle in Success. Because success is cyclical. I mean, it's not only cyclical, but cyclical influences play a big influence in cycles. And you have to remember that success carries within itself the seeds of failure. Failure carries within itself the seeds of success. And so when venture did too well, it attracted too much money, which caused it to fail. Then the failure meant you couldn't raise much money, so the little bit of money that could be raised was invested without much competition to invest and did very well. But then it attracted too much money, and so cycles are never ending. And so you have to be cognizant of the environment you're in, and there's few things as dangerous as being in an environment where there's too much money around and people are too eager to put it to work. So I think my son has heard that lecture before.
Next question, please.
Hi, Mr. Marks. You spoke a bit about behavioral biases today. You've written about them in the past. I wondered if you could comment on what behavioral bias you think you have struggled with the most over your career, and what frameworks, mental models you've put in place or tried to put in place to try and mitigate or control that bias.
Sure. Well, first of all, when you say Mr. Marks, somebody told me yesterday that he had sent me an email addressed to Mr. Marks. I said, oh, I forwarded it to my father. You know, who here, whose parents were alive during the Depression? Few hands. Okay. Whose parents were adults during the Depression? Like mine. And you know, my parents were born in the first decade of the 20th century, which meant they were adults during the Depression. And so, if your parents were adults during the Depression, what did you learn? Don't put all your eggs in one basket. Save for a rainy day, and worry like crazy. My father was the world's champion pessimist, and I would say that I have been too conservative in my life. You know, and kind of chicken. Now, that made it good for me, because when I went into these new oddball asset classes like convertible bonds, high yield bonds, distressed debt, emerging market equities, and things like that, I was able to espouse and convince people that we would take a conservative approach to a risky asset class, which was successful. However, I think that when we set up the culture at Oaktree, we probably made it too risk averse. and that's not good. So I think we try to be a little more expansive today, but it's hard to change your personality. For many of us, the best you can do is be aware of your biases.
Another question?
Thanks for taking my question. Howard, you talked about the comment from Warren Buffett about the preferring the lumpy 15% to the smooth 12. I'm curious your thoughts on volatility and just some context on that. You know, I don't disagree with Warren Buffett very often, but I would argue I take the fixed 12 over the lumpy 15 because definitionally that depending on how volatile it is, that 15 might go to 20 or 25 later and I could sell my fixed 12 and buy the 25. So at a value investing conference, I know a lot of people say volatility doesn't matter and it's just asset impairment, but I'm sure you've thought a lot about it, and I think volatility does matter, so I'm curious your thoughts.
I think that the main reason volatility matters is because of the realities of the people whose money it is. And you know, it's easy for the investment manager to say volatility doesn't matter. But by the way, so I was talking about my experience at Penn. And when Penn asked me if I would take the job, July 1st of 2000, I said I will, but you know, I'm not going to jump on the bandwagon of tech and venture and ride the bandwagon off the cliff. So I'm not going to change it overnight, and we didn't. And so we had a rather cautious portfolio going into the global financial crisis, and did very well. Other institutions, other endowments that went for the, shall we say, the lumpy 15, had to freeze hiring, freeze wages, freeze construction, maybe sell closed-end funds at a discount to NAV, borrow money, often in the taxable bond market. So the realities of one's existence can mean that volatility has some importance. So you can never ignore the conditions under which you work. One of my favorite sayings is that never forget the person who was 6 feet tall, who drowned crossing the stream that was 5 feet deep on average. The idea of surviving on average is irrelevant. You have to survive every day, which means you have to survive on the bad days. Silicon Valley Bank really was not fundamentally insolvent. It was insolvent at a moment in time. It happens that at that moment people asked for their money back, and it couldn't give it to them. So I would say that it's important to keep the realities in mind. By the way, as to Buffett's lumpy 15, there's a book out called The Warren Buffett Way, and I was asked to write the preface for the recent edition. And I wrote something called What Makes Warren Buffett Warren Buffett? And I list the things about him. High degree of intelligence, quick study, figures out what's important, ignores what's not important, sticks to a few things, doesn't feel he has to invest in everything that comes along, high degree of patience, willing to sit on his hands for a long time. But you know what the last one was? Can't get fired. And people who can't get fired have a much greater ability to ignore volatility than the people who can. So, realities. Now, your argument that if you put your money into the safe 12, you'll be able to pull it out and go into the things that used to pay 15 when they get up to 25 is a good argument. The only thing is the thing that pays 12 will only be selling at 80 cents on the dollar in that climate, so you may not feel like doing it. But you know, it's clearly not realistic to say we can completely ignore volatility. I just think that concern with volatility is overdone. The greatest thing you can do is build a relationship with your clients that permits you to take more volatility than otherwise. And I think that I spend a lot of time trying to build relationships with clients because you have to have a meeting of the minds. And if you don't share expectations and if you don't share an understanding of the realities, then you can't have a successful relationship for long.
Okay, I think we have time for one more at the back there. Yeah?
Yeah, thank you for taking my question. Howard, just a quick question. Just want to see if we can reconcile this because, at a value investing conference, right, I'm just thinking about the market as a whole, the S&P 500 trading around 18 times PE or about a 5.5% earnings yield with inflation running, between 5 and 7%. In this new environment, the sea change, I just want to know how you reconcile that. In other words, is just the market excessively expensive? Is it we're not trying to predict the future, but just looking at the valuation in terms of the market and investing over the next few years. Just want to know how you reconcile that. In other words, you're getting a 5.5% earnings yield in an environment where it doesn't even beat inflation. Thank you.
Yeah, I think that I guess what I would say is that over the last year, the optimists have been winning the tug of war. And the optimists think that inflation is going to cool off and permit the Fed to pivot soon. And we're going to go back to that version of normal, which I don't happen to agree with. So I think that the market's somewhat overvalued, not criminally. It's a little overvalued. The P ratio is 19, maybe on the S&P 500. The post-war average is 16. If today's interest rates are normal, and then that should be coincident with a normal PE of 16. It's 19. It's 20% overvalued. I don't think you can argue that it's crazy overvalued. In 2000 it was 32. But it's certainly not undervalued. And, look, I believe that there's probably a period of adjustment ahead for the S&P, but I don't see a huge collapse, just a readjustment to this new environment, which hasn't taken place yet.
Hi, Howard. You've written a few memos over time on cryptocurrency. And your views have evolved. I just wanted to get, as a final take, what your current thinking is. Thanks.
87, I read a good article which introduced me to the idea of this time it's not any different. People in the investment business always say, well, that now it's different, which means that the past is irrelevant and the rules of thumb which obtained in the past don't matter. And usually people get into trouble when they say this time it's different. Of course, Bitcoin and crypto are manifestations of this time it's different. However, in that article, it was October the 11th of 87, John Templeton, who I think really raised that discussion of this time it's different, said, but remember, 20% of the time it is different. And in today's day and age, with technology so ubiquitous and the gains so rapid, I would think it's more than 20% of the time that things are different. Now, crypto is, the first time I ever discussed it in a memo was in 17. I think it was a memo called "There They Go Again," because in good times, as I said before, imagination takes flight. And I was listing several things that I thought were indicative of the fact that we were in a high-risk environment, one of which was the success of crypto. And I said, there's nothing there. There has no core. It's not exchangeable for anything. There's nothing behind it. There's nothing to it. It's not something that you can invest in intelligently. I think I was too dismissive. Of course, I lived with my son and his family for the first 3 months of the pandemic. I got beat up daily on the subject. And my son made a pretty good point. He says, how can you talk about things you don't know anything about? Point taken. So I try to avoid doing that now. But you know what? Crypto is something that is incomprehensible for most members of my generation and clear as day for most members of his. And, you know, we don't need crypto in this country. You don't see it around. But what about a country where you can't get to the bank, you don't trust the bank, you don't want any record of whether you have money, you don't want the government to know that you have money because you're afraid they'll come take it away, some despot. Maybe it does play a role. And so I'm less doctrinaire about it today, and and certainly not dismissive. And it's worth noting, by the way, that crypto, Bitcoin, is like 14 years old now. And Andrew insists that most scams don't last 14 years, but of course Madoff did. You know, Bitcoin is famous for having fallen 80% from its high, but it's almost double this year, I think, maybe double. And, you know, when he bought it in March of 20, because he thought it would benefit from the pandemic, it was 5,000, and now it's 30. So I certainly don't have the ability to tell him he's all wet. You know, since I don't believe I have a crystal ball about almost anything, I end a lot of answers the same way, and I'll give you that here. We'll see.
Howard, Cyrus, thank you so much for taking time of your busy schedule to come and